Good evening, Doc Severson here for the Theo Night Report for Tuesday, November 21st. We have about 30 minutes left to go before the cash market closes, and what we're seeing right now is after a pretty strong day, the price has gone up to the weekly expected move. So the weekly expected move for the spiders was about 2 points from Friday's close, and it made up that ground most of today. So the price got up to the expected move fairly early today and has hung around up there and has been unable to get above that level. Now what's important here is not only the expected move, but also we have the massive 2600 level or 260 on the spiders. You can see the trajectory of the price action today with really the gains started overnight in the European session, and then once we got to the cash open it just accelerated up to that 2600 level there. You can see that just got above there and was very quickly rejected from that level. So we seem to be getting kind of soft into the close with really only another day and a half left to trade for this week. So the market continues taking the path of least resistance to the upside, but I'm not sure how long that's going to last though. Now I brought this chart up before. This is the percentage of stocks in the S&P 500 that are above the 200-day moving average. Right now it's 71% are above the 200-day moving average, which means by extension that 29% of them are below the 200-day moving average, which is generally a delineation for an uptrend between above and below the 200-day moving average. Okay, so let's also look at the Nasdaq. So we're going to look at the NDX above 200, and right now we have 67% are above the 200-day moving average, meaning that 33% are below the 200-day moving average. Yet we are at all-time highs today. So what does this mean? Well, it means that the usual suspects are being bought, as well as any combination of short covering, buying momentum stocks into the end of the year. So you can see here with the looking at the Dow Jones and the blue chips here that we have pretty good breadth across the board. We're up 25, down 5, and it's tough to even see the ones that are down right now. So Walmart's down slightly. We have GE is down, of course, again. But everything else is zooming. I mean, and this is because we have the usual suspects like Boeing is, just on a rocket ride right now. We have NVIDIA has been in this mode for literally the last year. And then, of course, we have the usual suspects of Facebook. We have Apple is rocketing higher today. We have Amazon moving higher today. So all of these are above 1% gains as well too. Here we have Google up 1.37% today. We have Microsoft is up almost 1.5% today. But when I look at the indices like the S&P 500, we're starting to see some real warning signs here. And this is not me being a bear or anything like that. This is me being as objective as I know how to be, is that we have just never run into signals that we have this amount of linearity. And linearity typically means that from range expansion like this, especially when we have euphoric range expansion like this, we have extreme linearity. We have very low. You can think of this as like a fuel gauge, where we have big values like this mean that we're about to get a big move, and this is what we did have in 2015. On the other hand, very low values like what we have here typically mean that we're going to get into a heavy dose of range contraction and just chop. And so we've had these low values for quite some time, and the only thing that's different right now and what is a technical trigger for the recent buying today has been that we have very high daily values right now. So all this chop over the last month on the S&P as well as every other index is creating a huge amount of short-term energy, which might bring us maybe about 70 points or so, in this case to the upside. But then we're going to run into triple exhaustion again, and then we're going to be right back to where we were about a month ago. So range expansion, range contraction, we are really getting down to the very last little bits of this rally where we're just fighting over scraps, or we're rallying maybe 50 to 70 points and then going sideways for about a month. Rallying 50 to 70 points, going sideways for a month. The real risk for this rally is going to be when one of those major stocks has a hiccup, when it creates contagion amongst the other stocks because they all end up falling like dominoes at that point. The last time that we had exactly the same thing, this was the result of it. We had several months of big-time volatility. This is where quiet and trending turns into sideways and volatile before it turned back into quiet and trending again. So we're just waiting on our next portion of sideways and volatile. Last week, what I talked about was the volatility is starting to increase. The realized volatility is starting to increase, which we can bring up through the ATR. We're seeing this on the S&P 500 here, that the realized volatility is starting to peak up, starting to perk up here. And this eventually causes it to propagate to the larger time frames. So we may be enjoying yet another year-end rally. We've got about 5 weeks left to go before the end of the year. Fund managers are going to do everything in their power to keep this thing pushed higher. But for those of you thinking that, this means that 2018 is going to start in an awful way in January, we can go back to 2014 because after 2013 we had about a 30% rally, right? So if we go to 2014, all we saw was a little bit of weakness early on in January. And as you can see, that was only to the tune of about 6%. We only had about 6% of downside. I'm sure that caused a huge panic back then. I don't even recall it. I mean, everybody held their breath at the end of 2013 and thought that all hell was going to break loose as we got into 14, and that is not what we saw. It took several weeks for that to actually start to happen. It was only 6% down. Really, things didn't start to become unhinged until we had the little Ebola correction back here, which was 10% to the tick in the full S&Ps. Okay, so putting this all together, what can we deduce from this? Well, markets are obviously heading higher. Every little dip is being bought. Momentum players are still in the market. They're focusing only on a very small number of stocks right now. We're seeing some very disturbing divergences across the breadth of the market. So if there is one little trip up, if there is one straw that breaks the camel's back, we might see a very quick 6 to 10% coming along. That is unlikely to happen before the end of the year. But of course, anything can happen in markets. That is it for tonight's report. Thanks for listening, folks.